Hi there, it's Mike again, and in this video we're going to look at the detailed calculations for the capital gain on a principal residence. So the CRA guidelines for the principal residence are summarized as follows. You have to live somewhere, but you can't live in two places at the same time. If an individual owns more than one residence, the CRA allows the taxpayer to make a designation of which residence is the principal residence, and this designation is made for each year. This is key because the calculation for the taxable capital gain or the exemption that we're going to choose will be done based on an annualized number. So whatever capital gain a property generates, you want to know how much capital gain per year that property generates. And the key is to eliminate those years that generate the highest capital gain, because that's what we're looking for, is to get those years to be tax exempt. Third kind of guideline is even if you own multiple residences, you can only designate one residence for each year. And the formula that CRA allows has the effect of providing an additional year of tax exemption. So it's a little quirk in the calculation that they allow us to use. So let's have a quick look at the CRA formula for principal residence. So that formula, basically, if we break it down, we take the total capital gain as being A, that's the capital gain we would have realized, and from that capital gain, we subtract any years that we resided and chose that residence as our principal residence, because we're going to eliminate from the taxable capital gain that portion which is tax exempt. So the total capital gain on the disposition of the principal residence is A. B is the number of years the property is designated as the taxpayer's principal residence. And the quirk here is that CRA allows us to add 1 to that number. And C in this formula is the number of years that you occupied the property. So it's a quite easy formula once you get your head around it. So let's look at a concrete example. Mrs. Jan Sadat owns a house in Ottawa and she owns a cottage. And she purchased the house in 1998 for $126,000, and the cottage was gifted to her in 2001 by her parents for an amount of, well, at the time the fair market value of the cottage was $85,000. Now in Canada, that gift is considered to have an adjusted cost base for the taxpayer of $85,000 as it was a gift. So during June 2007, she sold both of her properties, the house for $198,000 and the cottage for $143,500. And she lived in Ottawa and lived in the house, but spent her summers in the Westport cottage. This is really irrelevant in the way we calculate taxable capital gains on principal residence in Canada. We have a designation that we can make. So we're going to try to determine the minimum capital gain that she can report on the 2000 sale of the two properties. Once again, the goal here is to minimize our capital gain by maximizing our tax exemption. So here we are at the spreadsheet that would analyze what we should do in terms of designation of the principal residence. Now this designation would be made on a form and included in your income tax return. So it's very important to know which one of the houses we're going to designate as the principal residence and for which year. So given that the formula that CRA allows us to use is an annual formula, we want to know several key pieces of information. The first is the number of years that we've lived somewhere in this scenario, we're ending with the year where we disposed of a principal residence. So in this case, total number of years was 9 years, and I've listed them here based on a purchase of a city home in 1998 and disposal of the two in 2007. The second thing we want to do is calculate what our taxable capital gain was. So in this case of the city home, she sold it for $198 and she purchased it for $126. The capital gain was $72,000. She owned it for 9 years. Therefore, there's an annual capital gain of $8,000 on the city home. In the case of the cottage, she was gifted the cottage when it had a fair market value of $85,000, and she sold it for $143,000. So in this case, she yielded a capital gain of $58,500. Now she only held on to the cottage for 6 years, so her annual capital gain on the cottage was $9,750. So since the annual capital gain on the cottage is greater than on the city home, what we want to do is maximize the number of years that we take an exemption on this capital gain. So the formula that I described a few seconds ago allows us to take the capital gain minus the portion that we designate this property as our principal residence. So in this case, the CRA formula allows us to take the number of years we designate plus 1. So we've got 9 years to work with. It's the total number of years that we're looking at. So we want to use as few as possible of those years in each calculation of the capital gain exemption. So if I take 5 of those 9 years and apply them on the cottage, plus 1, I'm in effect eliminating 100% of this taxable capital gain. So I've eliminated $58,500 of capital gain by choosing to designate this cottage as my principal residence for 5 years. So by designating it for 5 years, I've in effect achieved 6 years of exemption. So that's an exemption of $58,500. That will leave us with 4 years to designate. Obviously, it's the 9 years minus the 5 years that we designated on the cottage. Once again, the formula allows us to add 1. So if we come to the city home, we're going to designate it for 4 years plus 1, and that will give us 5 over 9 times 72,000. So 5/9 of the time that we own this city home will in effect become tax exempt. So in total, the total taxable capital gain will only result in a taxable capital gain of $32,000 because we've managed to achieve an exemption on $40,000 on the city home. And obviously that $32,000 would be included in income at 50% taxable rate. So to summarize, the annual gain on the house is $8,000, calculated as 198 minus 126 divided by the 9 years that she owned that property, while the annual gain on the cottage is $9,750, which was calculated as 143 minus 85 divided by the 6 years she owned that property. So given this, the total period she owned the cottage should be allocated to the cottage. Since the CRA formula allows us to add 1 to the number of years designated, we use 5 years for the cottage, in effect getting 6 years of tax exemption, which is the total number of years she owned the cottage. The $58,500 gain on the cottage is therefore completely eliminated and would be tax exempt. So that leaves us with 4 years to designate for the Ottawa house. And once again, the CRA formula allows us to add 1, in effect getting 5 years exemption on the house. So the total taxable gain on the 2 residences is therefore $32,000 that would be taxable. And that's the 4 remaining years that we didn't manage to get exempted at an annual capital gain of $8,000 per year. So I trust that this has helped you sort out a little bit the calculations surrounding taxable capital gains on a principal residence, and in particular someone who owns multiple residences.